Hi, good evening, everyone. Um, Good evening, everyone. This is Mark with Right Line Trading, and I welcome you to our webinar this evening. Just let me get the slides moved over. And first our disclaimer that signals and trading opportunities provided are disclosed to visitors. Um, that are disclosed to visitors. Subscribers are for educational demonstration purposes only, and participating in and trading in forex and futures markets involves substantial risk, and you can lose a substantial amount of money. Um, do your own due diligence. Consult a financial advisor prior to making any trading decisions. We are not registered financial advisors, not a licensed commodity trading advisor. Subscribers agree to pay a fee. Um, and you can't reproduce or transmit or publicly display any of the information or materials relative to right line trading. Now, a little bit about myself. Um, I'm a graduate of the University of Pennsylvania and a former professor at Jefferson University in Philadelphia. I've been involved in the financial markets for over 20 years, and I began trading the futures and forex markets about 10 years ago. And in my postgraduate work, I was involved in the optimization of software systems. And in fact, and for my thesis, I did work on the optimization of a multivariable equation that described all the physiological changes and all the physiological parameters that a deep sea diver underwent when he underwent underwater decompression. Now the slide just moved on its own here. Hold on a second here. I don't know why that happened. And and when I became involved in the futures and financial markets, I looked upon the movement of price as the same type of system that I did underwater decompression. That there are a series of multivariable equations, or a series of there are a series of independent variables that define price movement. And when these independent variables are placed in an equation and individually optimized, then you can create um, a closed system in which the ability to predict future price movement is exceedingly accurate. What you must determine, and what the most important feature of the system is, you must determine what those independent variables are and what the dependent variables are. And the reason that most people who day trade lose money, and it's 95% or 90% of day traders ultimately go bankrupt, is because they consistently use the same dependent variables to trade that the prior generation of day trader have used. There's no in this science of day trading is really not a science. It's an art. And because it's an art in its present form, it doesn't evolve. So what you have been taught is the same thing in all likelihood. That's exactly what's been taught to the prior generation of day trader. And that prior generation is the one that failed at a 95% rate. So what you want to do is determine where these day traders went wrong. Why did they lose all their money? And the problem, again, that's been going on is nobody profits from anybody's mistakes. And people take for granted information that's been handed down to them, uh, by each generation of day trader as being true a priori with no rigorous scientific testing whatsoever. And that leads to the absolute unacceptable failure rate in this industry. As commercial traders, 50% of us should fail and 50% of us should be successful. But instead, 95% of us fail and 5% of us are successful. And we give all of our money to the institutional traders. But half of us should profit from the other half of the commercial traders. And for some reason, we just can't do it. And that's really the reason why. This is great because my slide presentation here is going wacky. Oh, here we go. Now, what we've configured is called the transition zone trade. Now, it's a single configuration trade that can be taken either discretionarily in the trading room or via an algorithmic automated system that enters the trade for you and manages it for you. And it's the most profitable trade configuration that we've ever developed. And after 2 years of forward testing using market replay data, we found that greater than 85% of the trade entries are winners. And there's superlative risk to reward. This is the kind of trade that you want to find when you day trade or you trade futures. The more times that you have to take a trade in the course of a day, the more times you place yourself at risk, the more times you can get slippage, the more times something difficult can happen to you. You want to take a minimum number of trades with the highest risk to reward possible. And for every dollar of risk, you make $3 on average on a trade like this. And it leverages the direction of institutional money. And I should have put in this slide that it really leverages the direction of institutional money, and you'll see how that creates certain situations in the market that we're looking for. And with only 2 contracts, you can easily make $500. Now that's on crude. You're going to make less, but you risk less on the E-mini. But you'll see that. Now, remember we talked about independent variables. And this is not meant to be a comprehensive webinar about the state of the art of day trading. I mean, that's for our trading school, and it takes 8 weeks. But a lot of software packages have background bias. And background bias, you'll see a pink color in the background, or you'll see a green color in the background. And that's because when price falls, it creates the pink. So the pink color is governed by the direction of price on your trading chart. And this background on most software packages is no different than having a set of paint bars. You know, that whatever moving average or MACD system governs the paint bar, when the price of the trading instrument moves to the downside or the moving average moves to the downside, whatever the signal is, price on your trading chart will determine the color of background bias. What we do is we make sure that the background bias is an independent variable, totally independent of price movement on your chart, because it's created by the position of your 2 higher time frames. Now, when you're trading a crude 8 range, your 2 higher time frames are your 2 higher fib numbers. Oh, this is a crude 5 range. So your next highest time frame would be 8, and your next highest time frame would be 13. So we default to the 2 higher fib numbers. So on the 8 range and 13 range, when the 50 and 15 are moving to the downside, price is below the 50 and the 15, and all support to the downside is broken, then you see this pink background. So the development of the pink background has absolutely nothing to do with price movement on your chart. That's a true independent variable. So that price falls because the background is pink. The background bias is pink, not because price is falling, but you know that when your higher time frames align to the downside, both your two higher time frames, 8 and 13 range in this case, and they're not just trending to the downside, but the 15 is below the 50. It's a whole set of criteria. And in addition, and most importantly, price has broken support to the downside, that price on your trading chart is strongly biased to fall. The pink doesn't create an entry, it creates a trading bias. And it would be very difficult to take a long trade when background bias is pink. You're looking for a short entry. Now, the other major independent variable that we leverage for this system is known as, we call it our quant analysis indicator. And what it does is it looks at the correlative markets. And correlative markets, all trading instruments, bonds, notes, the E-mini, the Russell, the NASDAQ, all the currencies, all the agriculturals, all the energies. What major institutions do during the course of the day is they do sector rotation. They're moving their money, and this is the big institutional money, into the sectors that at any given time they find to be the most favorable. And when risk is on, they're going to move their money into stocks. So you're going to see most likely a rise in the Russell, the E-mini S&P, the NASDAQ, and the Dow. When the risk is off, you're going to see a fall in stocks, and you're going to see a rise in the safe haven instruments like bonds and notes, gold, silver, even palladium. You're going to see a rise in the currencies, whether it's the basket of European currencies, the Canadian currency, the U.S. dollar. So really what the institutions create are correlative markets. And those are markets, and we're looking at bonds. And there are certain instruments that when bonds go up, they fall. And certain other trading markets that when bonds go up, they go up. I mean, and for instance, when bonds go up, there's a hard correlation with notes going up. When bonds go up, there's certain other markets that go up at the same time. And these are correlative markets. Now, if the market goes up, when bonds goes up, another market goes up 70% of the time in tandem with bonds, then what you have is a correlative market. The bond instrument and its correlative market are both going to rise. Now, certain other instruments are going to move in the opposite direction. When bonds go up, it's usually going to be very likely that that stocks and the more riskier investments are going to go to the downside. So what we've done is we've created a quant analysis indicator. And what this does is each line looks at 3 correlative markets. So there's 6 markets that this is analyzing. And this is a really great indicator to analyze money flow. Because when you have dual green lines, what this is telling you is that money is flowing into bonds, and it's 6 correlative markets. Some of them go up when bonds go up, and some of them go down when bonds go up. So money is flowing in the appropriate direction to move bonds to the upside. And I hope I made myself clear on that. The correlation can be a direct correlation or an inverse correlation. But the direct correlation or the inverse correlation has to be 0.7 or greater. It has to occur 70% of the time. So this is really just a creation of institutional sector rotation of big money. Because when you have six markets all moving in the appropriate direction, either up and down in correlation with bonds, and it tells you that money is going to flow into bonds and its correlative markets and out of the instruments that are inversely correlative to bonds, you have a great bias, and that bonds are going to tend to move up. And you can see, and I'm going to show you our trading platform. You can see that when you get dual green lines, bonds get pushed to the upside by the flow of institutional money into bonds. The lines are in green because price goes up. Price goes up because these lines are green. That's a complete independent variable. Now, there are many, many more that we use, but I wanted to show you, excuse me, I wanted to show you, I'm just getting over a cold. I wanted to show you the major, just excuse me for 1 second, because I just need to get a sip of water. Okay, thank you. So the reason we call it the quant analysis indicator, because the markets that correlate 0.9 or move in tandem or either in the same direction or in the inverse direction, 0.9, 90% of the time, are quantitatively weighted more heavily in the quant analysis indicator. Now, there are 2 lines on bonds. There are 3 lines on the E-mini. Each instrument has only a certain number of correlative markets that we can find in doing forward testing on about 75 markets. The most we could find on bonds were 6 markets. The most we could find on the E-mini, the Russell, and the NASDAQ were 9 markets. The most that we could find on crude and gold were 3 markets. So you're going to get a different number of quant lines in different instruments, but each trading instrument has its own unique quantitative analysis indicator. Now, the other thing that's extremely important is trading out of an area defined by market structure. Now, our system is designed to read market structure. And if you look at right here, what you have is you have a period of consolidation. And our system will trade out of consolidation. And consolidation almost always breaks down in the direction of the trend, unless the market is exceedingly oversold. And I'll just tell you as an aside that oscillators don't work. If you think it's going to call an overbought or oversold market, you're wrong. If you're going to use it to counter trend trade, it's going to fail. Divergent signals are horrific. And if you're going to use it to tell you that on an overbought market that the bulls are in control and you keep buying higher and higher pivots, you're also going to fail. The oscillator has no predictive value in determining future price movement whatsoever. It's an elegantly created indicator, and you've been taught that it works. But when we scientifically analyzed it, it did not increase your trading precision one bit. And that's one of the things that I teach in trading school: what indicators actually work and what don't. And if you actually go into the literature, the world literature, and do a Nexus-Lexus search, you will find no scientific papers that analyze the mathematical validity of an oscillator, whether it's stochastic, whether it's the RSI, whether it's the CCI, whether it's the Williams K. They all are just tweaked and variations for the same formula, and they all fail. So let me just get back to consolidation. And the rationale for consolidation and why you want to trade out of consolidation, and the reason the system takes a trade out of consolidation on the transition zone, is because consolidation traps traders. You can see that this candle has a predominance of sellers. They're trapped to the short side. This candle has a predominance of buyers. They're trapped to the long side. Predominance of sellers, predominance of buyers, predominance of sellers. And all of them are nervous because if the trade doesn't break in their direction, they're going to get stopped out. Now, the longer the period of consolidation, the more traders that you trap in a counter trend direction. And the one thing you never want to be in is in the counter trend direction. Because remember that institutions create trends. And I don't want to get obtuse, but every closed system, and I've quoted, I've said this many times before, and everybody in the office tells me I'm being, a little too scientific, and it's not, it's not really germane, but it's germane in the sense every closed system, no matter what it is, obeys the laws of thermodynamics, which say that every closed system tends to go to a state of maximum randomness. And if you've ever wondered about what creates chop is what takes place in every financial instrument under normal circumstances. Because under normal circumstances, the market as a closed system is simply going to move in a maximally random fashion. When it trends, just like any other closed system, in most closed systems, you bring about order via the application of energy. In this system, you bring about order via the application of money. And it's institutional money that create a trend. And when you see the 50 period down and our 15 period, this is really a proprietary moving average, it's not the EMA heading down, then you know that institutional money is being brought to bear here, and you want to trade in the direction of the trend. Almost always, consolidation will break out in the direction of the trend, and we're going to take a transition zone trade out of the trend down. And the system will tell you when consolidation is most likely to break to the downside. You're going to get a system signal, and I'm going to show it to you. And it moves down with two forces. One, the addition of new sellers in an institutionally created downtrend, and the fact that all of the buyers caught in the counter trend direction are going to get stopped out. And there may be a significant number of contracts stuck in the counter trend direction. There could be hundreds if you're trading crude and thousands of contracts if you're trading the E-mini. So it's not a trivial thing when all the buyers here get stopped out and push this trade to the downside. So what the transition zone does is it seeks to leverage this. Now, this black line occurs when there's a transition zone. And the transition zone is the movement from no background bias color to some of the weaker background bias colors to dark pink or to dark green, telling you that the two higher time frames on your trading chart, no matter what your chart is, whether it's a 377 tick, whether it's a 3-minute, whether it's a Renko, whether it's a range, the indicator automatically calculates the two higher time frames. And it tells you those two higher time frames have come into alignment. The 50 is down, the 15 is down on the two higher time frames, and they have broken support of the 50 and the 15. So price is trading free and clear on the higher time frames to the downside. And what you look for is a pullback on your trading chart into what is a strong downtrend on your two higher time frames. And you look for that pullback to occur quickly, because the faster you get it after the transition zone, the more powerful is the continuation signal and the continuation to the downside. Now, I told you about the quant lines, and I told you that the E-mini, and this is a chart of the E-mini, has 3 quant lines. They must all be red. And actually, we've loosened up the transition zone algorithmic entry. You actually only need 2 of them red now. 1 can be yellow. And if you look in here, it's hard to see, but that is a triangle. And that triangle is a trade out of consolidation. So you get a small counter trend move to the upside on your trading chart into this strong downtrend on your 2 higher time frames. And the market is almost always going to continue along the lines of the higher time frames. Now, sometimes it's not going to go 17.5 points to the downside on the E-mini. Sometimes maybe it'll go 7 points. Sometimes it'll go 6. Sometimes it'll go 3 points or 2 points. The point is, though, is that the frequency of getting a successful trade, i.e. that you make money on this trade configuration, is incredibly high, because the follow-through rate to the downside without getting stopped out is enormously high. Once you get a confirmation signal back to the downside, that trade has an 85% likelihood of continuing through to the downside. And that is really the strength of the transition zone. It leverages background bias. It leverages the 50 and the 15. It leverages the quant lines. And it triggers the algorithmic system, which can get you in automatically. Or if you learn the system, you can take the trade on a discretionary basis. Or if you're in the trading room, you can hear me scream them out. Because when I see one, we're on it. And I think this week I took a transition zone, and the algorithmic took it. Now, we only trade it with a tiny number of contracts to give people with a very small account, the ability to trade it. We trade it with 2 crude contracts and 2 E-mini contracts. And we can take the trade with 4 contracts, with 8 contracts on crude and 10 contracts on the E-mini. But my goal is not to present you with a gigantic number for our upside. What my goal is to present you with is an amazing number of winners, because we trade the system with a very small number of contracts. And we do that on purpose, and that is so that everybody can trade. Now, here's another transition zone trade. And this doesn't have the algorithmic signal, but you can see the pullback candle comes on the creation of the transition zone. And these are extremely powerful. And I believe we had one this week. So the pullback candle initiates the zone. And when these happen, this went 61 ticks without a 15-tick pullback, because that's our runner. We're looking for a big move. But from entry to the top of the trade, it went 61. Now, there are 3 criteria for exiting the trade, and I'll go over those for you when we go over to the actual trading platform. But really quickly, the first target on crude is 7 ticks, and the stop's at -7. So you're up $70, and if the trade goes right back against you and stops you out at -10, you've lost $30 on the trade. Very, very, very little. And the stop's at 10. When price hits 10 ticks, the stop goes to -5. Now the worst that can happen is you make $20. So you've covered your commissions on 2 contracts, and you have enough to take your kid out for a hamburger at McDonald's. If the trade then starts to move, that's when you start racking up the money. Now, if the trade goes against you, you're going to close on a reversal candle. and that's an automatic system close. So if the trade goes 4 or 5 in your favor and then gets a down close candle that hits the stop, you're going to be out at a very, very small loss. The initial stop is 10 ticks, but this system rarely will take a 10-tick loser. Max is a 9-tick loser. And if it goes 3 or 4 in your favor, you're looking at a 5-tick loser. So that's a $100 loss to an upside potential of close to $700. Here's another one. There's the algorithmic signal. Here's the green candle, the pull up in a strong downtrend, confirmation to the downside. This is a dark cloud cover formation. Entry takes you 34 ticks. On 2 contracts, the profit is $366 based on our current ATM algorithmic management. A great trade on crude with very small risk. Now, the system won't trade into a pivot, and it will not trade into market profile. If there, on a short trade, if there's any support below the trade, the algorithmic system will censor it. On a long trade, if there's any resistance above it, the algorithmic system will censor it. It will never anticipate the break of support to the downside or the break of resistance to the upside. The trade has to at least have room from the entry to your first target before the automated algorithmic will take a trade, or before we'll take a trade in the trading room. So I really went through the entry criteria for the transition zone. I don't want to go over that, and that's kind of boring. Let me just see what the next slide is here, because I think we're going to go over to the trading chart. Let me just see what's next. Now, the exit criteria, I'm just going to go over briefly. The 15-tick trailing stop can get hit. So now you can close the trade at any point on a discretionary basis if you feel like it. If you're up 30 ticks on the trade, that's a $370 trade, and you want to get out of it, you can. It's going to have to go to 45 ticks in order for you to lock in the same amount of profit on the 15-tick trailer. So it comes back 15 ticks. You're just going to sit back, let the algorithmic system take the trade, and you're not going to do anything to change it. So it's going to hit your 15-tick trailer. It's going to take the trade out at any upside resistance or downside support. When it senses that, it's going to close the trade for you automatically. It won't take a trade if it's got to trade through resistance or support, and if you're in the trade, it will close it at resistance or support. And then, if the modified 15, our 15-period proprietary moving average, turns yellow, the system will close the trade automatically. Now, this is there to help you not take that 15-tick hit on the close, on a pullback. But listen, that's really up to you. If you decide you want to close the trade at 40 ticks, you're up $470. You can just close it. You can do that at 10 ticks or 15 ticks. Listen, the thing is, though, is that the transition zone has the potential to run 30 or 40 or 50 ticks. So if you're willing to not get upset with yourself, if you leave a lot of money on the table, you can take the trade out early. Or you can let upside resistance or downside support take the trade out for you, or the modified 15 turns yellow. Okay, well, that's actually our special. And we're going to, let me get out of these slides and go to right here. Here is our trading chart. And today in the trading room, we made $517.50. And, I don't want to go into the trades because there's our 3 quant lines. This is momentum, multi-time frame momentum. This is multi-time frame order flow. These are all taken into account in the transition zone trade. And you can see how well it helps you take a trade on this entry right here. E-mini is hard to trade. Boom. We also have paint bars. You can see that the paint bar is red. You can see background bias is strong downside background bias. So you know your two higher time frames are aligned to the downside. They're not aligned optimally like they are with the dark pink, but they are aligned to the downside. You know, I'm not going to go over the meaning of the background colors because that's beyond the scope of this webinar. But you can see how the system leverages your trades by using all of these independent variables. And remember, momentum here and order flow here use a lot of data from higher time frames to calculate their color. These two indicators do use trading chart data, but also higher time frame data. So this is one winner we took in the trading room, and that was with two quant lines and order flow and momentum. What we want to do, this was a 21 tick trade that we took in the trading room, again, with the quant line, order flow, and momentum. I call these three aces. When you get the quant line or the quantitative markets rolling in your favor, and you get multi-time frame order flow, which is the bottom, and a multi-time frame momentum, you're very likely to get a continuation trade. And you can see it happen here, and you can see it happen here. We made 11 ticks here. We made 10 ticks here. And the problem here is we went 5, which is our first target, but we didn't get filled. And so the trade came back and stopped us out. But remember, we stop on a reversal candle. So even though it could have given us a $200 loss on 2 contracts, we limited the loss by taking the trade out. The entry is here. The reversal candle closes here, and it actually took a tick of slippage and closed +5, and we only lost 100. Now let's roll here. And here is your perfect transition zone trade. And I'm going to show you our transition zone spreadsheet right here. The pullback occurs on the zone. You've got enough of the candle body below the pivot and the value area low. And the trade, you have to look at the right edge to see where these are because these lines move. And this gives you a 35 tick trade. Here's another one. Now this occurs at 7:30 a.m. The algorithmic system would not be on, but if you understand the entry criteria, you're going to take the trade all the way down to here, 21. And you should take the trade right out at downside support. There's the pivot. As that candle wick comes down, you close this trade. You never make the supposition that the trade is going to break support. And actually, that's how the trade evolved. It's under the value area low. So you can see it's free and clear all the way down until it hits the pivot. Now, there's no transition zone here. This pullback is too late. You need a pullback fairly rapidly once the zone occurs. Here, it just moves right through. Here, the zone triggers, but you just get a precipitous fall. And here's another trade, because this candle is a pullback, and here's your continuation. Now, the reason we don't have any markers on it is I had to remove all drawing objects to create another set of slides for another talk. And that's just a modest 15 tick winner. It's not a big win. And let's see where we were on the right edge. That trade would have been censored because the value area low would have stopped the trade. And it did break support, but again, the system never makes the assumption that support is going to be broken. That did not. There's no pullback. It's just straight through. Too far off resistance to take a trade. Too high up, too overbought. I don't want to show you. I just don't want to make up entries for you. I want to show you real entries. This is too oversold, and we use an entirely different system for overbought, oversold. Okay, now I ran back 10 days on crude. Let me go back 10 days on the E-mini. Wrong background bias color, unfortunately. No pullback, just straight down. Nothing here. We lost 6 ticks here. Now here, we look for a wick to get it on a 1-tick pullback. We got no fill here. And this trade fell 6.5 points. And it left us sitting here with our thumbs in our nose, unfortunately. Right here. This is where we took the trade on the transition zone, and the algorithmic system took the trade on the transition zone. The algorithmic system made $137.50, and in the room, we also took the trade. We made $125. So if you were in both trades, and a lot of people were, if you go over to the right edge, you're going to see this is a discretionary counter trend trade that I took that went 3 that didn't win, and I'm certainly not going to tell you that every trade I take in the room works, but these are the stellar trades up here, and the algorithmic took the trade out at upside resistance, and I let it go, so it came back and stopped me out with 125, and the algorithmic made $137.50. And that's only on a small number. It's only 2 contracts. You trade 4 contracts on the E-mini, which is very easily doable, and you have a $250 trade with very little risk. And this was a 15-tick counter trend trade that made $187.50. You see, I write down the value we got on every single trade just for transparency. Here was an 8.25 point algorithmic. The second candle, and if you look down, you've got green, 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 green. Order flow, momentum, all the correlative markets, background bias. The trade doesn't even come close to getting stopped out. It goes into consolidation, breaks to the upside, goes into consolidation, breaks to the upside, goes into consolidation, breaks to the upside, and then it meanders back. So I think you see the trade configuration. This is really the most conservative, takes the smallest risk for the highest reward of any trade configuration I've ever seen. It leverages all of the independent variables we use on the system. It can be taken on an algorithmic system so that you don't even have to even be at your computer. Or it can be taken on a discretionary basis by being in the trading room. And as part of the special, We give you three. I'm going to show you what it is. We give you 3 free months in the trading room. So actually, you can even take my discretionary trades if you like, and you can take them all. And today, between the algorithmic and my trading, we made 517.50, and we did nice yesterday. So we're going into Wednesday in a very difficult market, up good money on a very small number of contracts. And believe me, this 150 was a hurt, but we came right back from it. We've made money right here. We made 137, 125, so we're right back in the game. And believe me, on a discretionary basis, we trade extremely well in the room because I try to be as conservative as possible as I can. Now, let me show you the special, and then I'll take any questions that you have. Oh, I want to show you our results. And just go to performance, go to drop down, and here's the transition zone results. And here they are. We had a trade on 10.4. On the ES, it made 50. On 10.7, it made 100. On 10.10, we made 112.50. On 10.12, we had 2 trades. One on the ES for 150 and one on crude that made 230. On 10.13, we had a crude 231. I don't know how we got $1 in there. On the ES, we made 137.50, and then crude we made 70. So on 1, 2, 3, 4, 5, 6, 7, 8 trades, we're 8 for 8. The profit's 1,081, and it's only for this month because the system's only been operational in October, and we've yet to take a loser. And that's really the key. The key is not the net profit, because we're only trading this with 2 contracts to create a small net profit. It's the number of winners versus the number of losers and the risk to reward. And the risk on these trades is exceedingly tiny. We just didn't get a huge home run, but we're going to get a $500 or $600 winner. But it just punches them out. And even if you only make a small amount of money, you're taking a very small amount of risk. And that's really the key to the success of the system. Now, this is the last time we're going to offer this, I can promise you. And I know people say that all the time, and they don't mean it, but we are. And we're only doing this because of the fact that we just started. We're offering normally the transition zone is $7.98 lifetime, but we sell it per market, and we're going to be moving it on the algorithmic system and on the discretionary, because I'll see when the algorithmic triggers a trade. But normally it's $7.98 per market. Now, I didn't change this, but it's not good through Sunday. Rory will send you an email. Rory, when's it good through? 72 hours. It's 3 days. So we're offering you all the markets and all future markets. And then $16.99 is the automated algorithmic entry. And that's all markets and all future markets. On the website, it's $16.99 per market, and that is how we're going to sell it from now on. You can buy it on a per market basis. You're not going to get all the markets, and you're not going to get all the add-ons. Maybe Rory will give you a break if you buy 2, 3, or 4 markets, but we're not going to let you have all these markets and all the add-ons. We're very close to adding the algorithmic on gold and adding it on the NQ. And the algorithmic system that you saw, I didn't really go into it today. Our algorithmic system, which is different than our transition zone, we have 2 automated systems, took a 26-tick winner on gold that got stuttered out of the trade, and but it made $260 on one trade but it's trading 4 contracts. Your risk is higher, but you have a potential huge reward. And it had an immense trade on gold. But we're going to be moving the transition zone system to gold in the NASDAQ. And everyone who purchases, we will give a webinar on exactly how the trades work in much more detail. So that if you're going to trade it on a discretionary basis and go for the 798, you're going to know exactly what I look for in the trading room and exactly what the algorithmic is looking for to take a trade and maybe even I beat the algorithmic today on yesterday on that E-mini where we both took a trade and we both made about 150 each. Now, it's not the first 5. We did that the last time, and honestly, the first 5 went so quickly that all we did was make people upset. So we're going to leave this out, and it's just going to be if you make the purchase within those 3 days, you get 3 months in the trading room, which is a long time. You get 3 months of the NDT trade execution platform, which I'm not going to talk about, but it's really helpful. You get the weekly, every Wednesday I give a didactic session. I really give you, it's not a teaser for the trading school, it's really a piece of the trading school. I mean, last Wednesday I talked about order flow. I talked to people about the difference between market profile, volume profile, the footprint, and order flow. Because you hear those 4 things thrown around a lot, and a lot of people don't understand what volume profile is, what the footprint is, what the delta is. So we went over that extensively. Like I said, all new markets as they're added, soon gold and the NASDAQ. And it's not good through this Friday, whatever today is, Tuesday. Well, I think it is good. It's good through Friday. I just want to put this in here, just so you remember who we are. But we're rightlinetrading.com. You can email us at info@rightlinetrading.com. And our number is 855-765-6681. And Rory is literally here 10 hours a day. He's the go-to guy if you have any questions, if you have any technical questions. Now, Leo will configure the whole system for you. You don't have to do anything on the tech side. We do everything. And we make sure you get the trades on a timely basis, that they get shot into your computer fast. The one good thing, and then I'm going to go to questions about the system, is that it anticipates an algorithmic entry very early in the candle. 2 ticks into the candle, it's going to see that there's a potential entry, and it's going to open the trade. And if the trade doesn't mature in the direction that the algorithmic needs it to, it will close the trade. So you're going to get the signal, and it's going to be sitting in your control panel early. It's not like you're going to get it on the 7th tick of an 8-tick candle or the 4th tick of a 5-tick candle, where maybe if your cable speed is a little bit slow, you won't get the signal in there fast enough. This anticipates early. Unless the markets, we don't trade market news. So in general, the market's not moving that fast. Now, the algorithmic anticipates quick, and I hear the trade fire in my headset. So, if I'm not looking at it, I can't miss it either. And that's why we were both in that last one, and we both made money on it. Remember, we're on different ATMs. Our automated trade management strategy is different on the algorithmic. I'm sorry, in the transition zone than it is in the room. So we made a slightly different amount of money. Now, let me see if there are any questions. Yeah, it is recorded. It is, Gary. And Gary, on this offer, no, there's not. But if you call and talk to Rory, you never know. So there's our number, 855-765-6681. Just do a few questions. I mean, we want to make you money. We really do, and we're here 24/7 to try to make sure that that happens. Now, this is recorded, and we'll send a recorded copy to everybody who's in the room. It won't be. We won't get it till tomorrow. But it's a terrific trade entry configuration. So I really appreciate everybody stopping by. And listen. In addition, the 3 months in the room is going to teach you how to day trade using trade indicators and signals that are true independent variables. And we couldn't have made 500 plus today, and yesterday we made just under 200, so we're up 700 this week. Our goal is to make $1,000 a week, and we're doing that on 2 contracts. I mean, that is a very tiny amount of money. So if we make $1,000 a week after commissions on 2 contracts, that's $50,000, and we do it live. So we have a very accurate system. And normally when a trade doesn't work, it's because I made a bad trade. I mean, almost always on a failed trade, it's because I anticipated break of support and it holds. I anticipate break of consolidation and it holds. I mean, there's sometimes you can't anticipate a break and it just doesn't work. So that's what usually causes a failure. I mean, we have a very, very high win percentage. I don't know exactly, but it's extremely high. So thanks so much for giving us your time. And listen, we hope to see you in the trading room. Whatever you decide to do, I really wish you the best of luck. I hope you'll make money. It's rough in the futures market because it's such a leveraged instrument that the market does everything it can to prevent you from doing it. The institutional guys institute this high-frequency trading, and they can run you right over. But if you trade with the trend, almost always that HFC or the HFT, the high-frequency trading, almost always moves in the trend. That's why these counter-trend traders get crushed. And if you trade in the room and you watch the counter-trend traders, they're going to get beaten to death. And we take advantage of them in consolidation and in many of our other trading configurations. We look for the counter-trend traders to be caught on the wrong side of the trade so we can run them over and take advantage of the fact that the institutions are going to perpetuate the trend in the direction, or perpetuate the trade in the direction of the trend, and also use the counter-trend people to stop out and push the trade in our direction. So thanks, everyone. Have a really great evening. And again, I really do hope to see everyone in the room. Take care. Bye-bye. I don't really need the Camtasia, Rory, because the recording thing was on. I did.
I started the webinar recording and you had already started for like 10 minutes. I noticed that nobody had pushed start.
It was
On the Citrix? No, on your
it's recorded. Shit.
on the
Leo's
Snagger?
have to cut that. Yeah, I had Snagger running for